Have you ever wondered that the biggest game in the stock market may not be happening in front of your eyes, but behind the curtain? The average investor watches the same few big stocks every day, follows the same index, listens to the same news, and believes the market is simply going up or down. But the real game is different. Money quietly moves from one sector to another, sometimes from technology into energy, sometimes from mega cap stocks into smaller but powerful companies, sometimes from popular trades into sectors that ordinary people are not even watching. And that is the moment when the big players enter first, ordinary people hear the news later, and by the time retail investors understand what is happening, most of the move has already happened. Welcome back to Dalio Marco Mind, where we break down the hidden story behind the market noise in simple language. Today we are going to talk about a quiet money rotation that may already be happening inside the market. This video is not stock tips, and it is not financial advice. This is an educational breakdown so you can understand how institutional money thinks, how big investors look at sector rotation, and why the average investor often gets trapped in the wrong place. Today's question is very simple. Are you really watching the market, or are you only watching what the media wants you to see? Because the biggest trap in the market is this. When everyone is watching the same thing, smart money has often already moved somewhere else. The average investor watches the news, reads headlines, follows the S&P 500, tracks the NASDAQ, looks at big names like Nvidia, Microsoft, Apple, Amazon, and Meta, and thinks this is the entire market. But the market is not only a game of a few giant names. The market is a massive chessboard filled with different sectors, different industries, different themes, and different cycles. On one side, there is technology. On another side, there is energy. On another side, there is defense. On another side, there is mining. On another side, there is healthcare. On another side, there are financials. And then there are small, obscure sectors that the average investor has never even searched for. And the most interesting thing is this: money never stays still. Money moves, money rotates. And the investor who understands that rotation starts seeing the market from a completely different angle. First, understand where the average investor goes wrong. Most people look at the market as if it is one single thing. If the S&P 500 is up, they think the market is strong. If the S&P 500 is down, they think the market is weak. But the truth is that inside the index, many different stories are happening at the same time. One day, the overall index may be flat, but energy services stocks may be rising. One day, the NASDAQ may look weak, but uranium stocks may be quietly accumulating. One day, the media may be talking about recession, but money may be quietly flowing into infrastructure, defense, oil services, or critical minerals. That is what ordinary investors miss. They watch headlines while smart money watches flows. Now take the S&P 500 as an example. Most people think that when they buy the S&P 500, they are investing equally in 500 companies, but that is not true. The S&P 500 is a market cap weighted index. That means the bigger a company is, the larger its weight in the index becomes. If one company is huge, your index fund automatically puts more money into it. If one company is smaller, less money goes into it. So you may think you are buying 500 companies, but in reality, a large part of your money is going into only the top 10 companies. That is why concentration in today's market is so high. A handful of mega cap companies have a massive impact on the entire index. When Microsoft, Nvidia, Apple, Amazon, and Meta rise, the whole index looks strong. But if those same few names start moving sideways or falling, retail investors feel like the entire market is dead, while at the same time money may be quietly rotating into another sector. This is where an important concept appears: the passive investing flywheel. Over the last several years, millions of people have started buying index funds, pension funds, retirement accounts, ETFs, 401k plans. All of them automatically put money into the index. And because the index is market cap weighted, more money flows into the biggest companies. That makes those stocks even bigger. Their weight increases even more. And then the next inflow again goes mostly into the same biggest names. This is a flywheel. As long as it is moving upward, it looks very powerful. But if momentum ever breaks, the downside can also be very fast. Now, does this mean mega cap stocks are bad? No, not at all. These companies are strong, profitable, and have been part of market leadership. But the problem is, if you are blindly buying only the index, you must understand what you are actually buying. You may think you are buying diversification, but in reality, you may be buying concentration. You may think you're getting broad market exposure, but you may actually be getting top-heavy exposure, and that changes the risk. So what does smart money do? Smart money does not fall in love with one stock. Smart money does not get emotionally attached to one narrative. Smart money watches the flow. It asks, where can capital move over the next 6 to 18 months? Where inheritance take 18 months? Which sector can benefit from the macro environment? Which industry has structural demand? Where is government spending going? Where is supply tight? Where are valuations still reasonable, and where has retail not arrived yet? That is the framework we are going to break down today. This framework has 3 steps. Step 1, understand the macro weather. Step 2, identify sector money flows. Step 3, find the strongest leaders inside the winning sector. The most important point is this: professionals do not start with the stock. The average investor starts with the stock. He asks, which stock should I buy? But the institutional investor first asks, which sector, which cycle, which theme, which flow? Because if the whole sector is strong, the leaders inside that sector have a better chance of moving. But if the sector is weak, even a great company can struggle. Now let's explain macro weather in simple language. Think of the market like weather. Sometimes there is sunshine, sometimes clouds, sometimes a storm, and sometimes the season changes. An investor's job is not to predict the weather perfectly. An investor's job is to dress according to the weather that is actually in front of them. If it is raining, you need an umbrella. If it is cold, you need a coat. If it is hot, you need light clothing. In the same way, if inflation is sticky, rates are still high, geopolitics is unstable, energy demand is rising, defense spending is increasing, AI data centers are consuming more electricity, and governments are trying to secure supply chains, then every sector will not perform the same way. The 2021 market was different. Back then, liquidity was abundant, interest rates were low, money printing was aggressive, and almost everything was going up. In that environment, even an average investor looked like a genius. But today, the environment is different. Liquidity is selective. Rate pressure still exists. Inflation fear still exists. Government debt concerns are present. Energy security is a serious issue. Global supply chains have become politically sensitive, and countries no longer want to depend on each other for strategic resources. So when the macro weather changes, the winners also change. 2 sectors are especially interesting here. The first is energy infrastructure and oil and gas services, and the second is critical minerals, uranium, lithium, rare earths, and mining-related industries. First, let's talk about energy infrastructure. There is a misconception in the world that the energy problem is over. People think renewable energy has arrived, electric vehicles have arrived, AI has arrived, and now the era of oil and gas is finished. But reality is not that simple. AI itself is creating massive energy demand. Data centers need electricity, cooling, backup power, and grid stability. Electric vehicles need batteries. Batteries need minerals. Charging infrastructure needs power. Solar and wind are useful, but they are intermittent. The sun does not shine at night, and the wind does not blow all the time. That means storage, transmission lines, grid modernization, and backup energy systems are all becoming more important. Now look at oil and gas services companies. These are the companies that provide equipment to producers, drilling technology, compressors, LNG infrastructure, pipeline support, offshore project services, maintenance, and technical services. These are the picks and shovels that may benefit from the energy gold rush. During a gold rush, the miners are not always the ones who get rich. The people who sell shovels, tools, transport maps, and supplies can also become rich. The same logic applies to the energy market. If oil prices remain stable or high, if geopolitics remains unstable, if countries make energy security a priority, if LNG demand rises, and if risk increases around the Middle East or shipping routes, then governments and energy companies spend more on infrastructure. That spending does not only benefit oil producers, it can also benefit equipment and services companies. For example, names like Baker Hughes, ticker BKR, belong to this theme. It is connected to oil field services, LNG technology, energy equipment, and industrial solutions. Then there are smaller companies in this space that provide temporary infrastructure, energy project support, construction site services, or related solutions. But here's an important warning. Not every stock is good, not every breakout is real, and not every theme produces immediate profit. That is why a framework is necessary. So, what does a professional investor look for in a chart? He does not only look at whether a stock is cheap or expensive, he looks at structure. Has the stock been building a sideways base for months? Is volume increasing? Is price approaching previous highs? Are institutions quietly building positions? Is the overall sector strong? Is relative strength improving? Is the stock performing better than the broader market? If the answer is yes, then that stock enters the watch list. Here is something retail investors often find strange. A professional investor often does not buy at the cheapest price. Instead, he buys slightly higher after confirmation. The average person thinks, if the stock is at 15, why would I buy at 15.30? But the professional thinks, if the breakout confirms at 15.30, the probability may be better. He does not want the lowest price. He wants the best setup. He is not buying a bargain. He is buying probability. That is the difference. Now let's move to the second major sector, critical minerals. This may be one of the most underappreciated themes in today's market. The world needs lithium, copper, uranium, rare earths, graphite, nickel, cobalt, silver, and many other industrial metals. Why? Because every major trend depends on minerals. Electric vehicles, minerals, batteries, minerals, solar panels, minerals, wind turbines, minerals, defense systems, minerals, AI data centers, minerals, nuclear power, uranium, grid modernization, copper, semiconductors, rare earths, and specialty materials. Now countries have understood another problem. If you depend on rival countries for strategic minerals, your economy becomes vulnerable. That is why the United States, Europe, China, Japan, Australia, and others are trying to secure supply chains. Governments are focusing on mining projects, processing facilities, domestic production, recycling, strategic reserves, and financing programs. This is not only market demand anymore, it is becoming national security demand. This is where lithium companies, uranium companies, rare earth companies, and mining services companies can become interesting. For example, SQM is a major name in the lithium space. Uranium Energy Corp, ticker UEC, is connected to the uranium theme. Names like CMP may be related to minerals and specialty materials, but again, warning, these examples are only educational, not buy or sell recommendations. Mining and commodity stocks can be extremely volatile. If you enter without risk management, even a strong theme can still give you losses. The uranium theme is especially interesting because nuclear energy is coming back into the discussion. The world wants decarbonization, but it also needs stable baseload power. Solar and wind cannot provide the complete solution unless storage and the grid are massively upgraded. AI data centers need reliable 24/7 electricity. In this context, nuclear energy can become strategic again. And the fuel for nuclear energy is uranium. If countries want domestic uranium production, uranium miners and processors can come onto the market's radar. The lithium theme is also important, but supply and demand cycles can be volatile. Lithium prices can rise sharply, then fall because of oversupply fears. That is why story alone is not enough. Timing also matters. A strong theme does not mean immediate entry. You need to study the chart, valuation, balance sheet, cash flow, debt, production capacity, jurisdiction risk, and institutional interest. Now let's talk about rare earths. Rare earth elements are used in defense, electronics, magnets, EV motors, wind turbines, and high-tech manufacturing. If geopolitical tension rises, countries want to secure rare earth supply chains. This sector receives fewer headlines, but its strategic importance is very high. This is exactly the kind of area where retail investors usually arrive late, while institutions quietly build watch lists earlier. Now, the real question is, how can an average investor follow this entire process? First rule, watch flows before news. News is often late. When a headline says this sector is hot, such a word is this price for smart money has often already built positions. Watch and flow means check and relative strength, comparing sector performance, observing volume behavior, identifying leadership stocks, watching ETF movements, and looking for signs of institutional accumulation. Second rule, look at the sector before the stock. If the sector is weak and you are randomly picking a stock, you are swimming against the current. But if the sector is strong and you pick a leader inside that sector, the current may be on your side. Third rule, a cheap stock is not always a good stock. Many retail investors are attracted to low prices. They think if a stock has fallen from 80 to 20, it is cheap, but maybe it can fall from 20 to 5. A professional investor asks, are sellers exhausted? Are buyers coming back? Is the stock building a base? Is the breakout credible? Is the sector supportive? Fourth rule, risk management comes first. A good idea can still become a bad trade if the position size is wrong. If you put too much money into one stock and it falls 20%, you will panic. A professional first decides how much he can lose if the trade is wrong. Many traders use a 1% portfolio risk rule. That means if the idea fails, only 1% of the total portfolio is at risk. Position size is built according to risk, not according to excitement. Fifth rule, scale in, do not go all in. The market never gives certainty, so a smarter approach can be to build gradually. First, a small position, then add after confirmation with a clear stop loss or risk plan. The investor who builds a full position in one day often panics during volatility. Sixth rule, make the exit plan before entering. Retail investors focus too much on entry and forget the exit. Professionals think about exit before entry. If the thesis is wrong, where will you exit? If the stock breakout fails, what will you do? If sector rotation reverses, what will you do? If profit comes, will you take partial profit or follow the trend? These decisions should be made before the trade. Now, understand an important psychological point. The most dangerous thing in the market is not ignorance, it is overconfidence. In 2021, many people believed they were geniuses. Every stock was going up. Crypto, meme stocks, growth stocks, EV names, everything was moving. Then the environment changed, rates went up, liquidity tightened, and many portfolios collapsed. The problem was not that people were bad. The problem was that they did not understand the market weather. They thought the sunshine would last forever. The same risk exists today. Some people think AI stocks will always go up. Some people think gold will always go up. Some people think oil will always go up. But in the market, always is a dangerous word. Market cycles change, leadership changes, winners rotate. Smart investors are not married to one idea, they adapt. Now let's build a practical framework you can use once a week. Every week, look at the market like a sector map. Compare S&P sectors, technology, energy, industrials, materials, healthcare, financials, utilities, consumer discretionary, consumer staples, and real estate. See which sectors are outperforming and which are underperforming. Then look at subsectors: oil services, uranium, copper miners, lithium, defense, aerospace, infrastructure, electrical equipment, data center power, and grid equipment. Then identify the top performing stocks, then study chart structure, then build a risk plan. You do not need to sit in front of the screen all day to do this. Around 1 hour a week can be enough if you are disciplined, but if you want to manage your money, you must at least give it that much time. People work 50 hours a week to earn money, but they do not spend 1 hour trying to understand their money. Then when a market shock happens, they say they never received a warning. Warnings do not always come through headlines. Warnings appear in charts. Warnings appear in flows. Warnings appear in sector rotation. A warning appears when the index is flat, but leadership is changing underneath the surface. Now imagine one example. Suppose the S&P 500 moves sideways for the next 12 months. Headlines will say the market is boring. But inside the market, energy infrastructure could be up 30%, uranium could be up 40%, defense could be up 25%, while mega cap technology stays flat. If you are only watching the index, you will say the market is dead. If you are watching sector rotation, you will say opportunity is alive. That is the real meaning of follow the money. We do not predict, we observe. We do not guess, we confirm. We do not chase headlines, we follow flows. But one more thing is important. Every rotation can also be fake. Sometimes a sector rises for a few weeks and then fails. That is why confirmation, risk control, and patience are necessary. You do not need to chase every move. The market gives opportunities every week, but not every opportunity is for you. A professional investor is selective. He follows boring discipline. A retail investor follows excitement. Now look at this through a Dalio-style macro lens. The world is in a transition phase. Debt levels are high. Governments are borrowing more. Inflation is not fully dead. Central banks are under pressure. Geopolitical conflicts are affecting global trade. Supply chains are becoming regionalized. And real assets are coming back into the discussion. In such an environment, capital can often rotate toward real-world infrastructure, energy, commodities, defense, minerals, and essential systems. This is not certainty, but it is a powerful macro theme. There is one more layer, AI. People think AI is only a software story, but AI also creates physical world demand. AI data centers need land, power, cooling, chips, copper, transformers, grid upgrades, backup energy, and reliable electricity. That means the AI theme is not only limited to NVIDIA or software. AI is also an infrastructure theme. The investor who only watches the obvious winners may miss the second-order winners. That is second-order thinking. If AI grows, electricity demand grows. If electricity demand grows, grid upgrades happen. If grid upgrades happen, copper demand rises. If data centers expand, cooling systems, power equipment, energy contracts, nuclear discussions, gas turbines, and transmission infrastructure all become relevant. That is the chain smart money analyzes. Now finally, let's create a realistic plan. If an investor wants to study this theme, what should he do? First, education. Understand sector rotation. Understand market cap weighting. Understand risk management. Understand breakout and base structures. Second, build a watch list. Oil services, LNG infrastructure, uranium, lithium, copper, rare earths, defense infrastructure, electrical equipment, grid modernization, and data center power. Third, compare ETFs and leading stocks in each sector. Fourth, do not chase entries. Wait for the setup. Fifth, define portfolio risk. Sixth, write down the thesis and validation points. Seventh, if you do not understand something, do not take the position. Cash is also a position. And remember, survival comes first in the market, profit comes later. The investor who survives can capture future opportunities. The investor who blows up in one bad trade may never see the next cycle. So the summary of today's entire video is this. The market does not simply move up or down. Inside the market, money rotates. Retail investors often get trapped in mega cap names and headlines, while institutional money quietly moves between sectors. The S&P 500 may look diversified, but in reality, it can give you top-heavy exposure. The macro weather has changed. This is not the 2021 environment anymore. Energy infrastructure, oil and gas services, critical minerals, uranium, lithium, rare earths, grid modernization, and AI infrastructure can remain important themes in the coming period. But every theme has risk, so blind buying is not the answer. Framework, flow, confirmation, and risk management are necessary. If you take only one lesson from this video, let it be this: do not chase stock tips. Understand money flow. Because the day you start seeing the market like a chessboard, you will no longer be a slave to headlines. You will understand where money is leaving, where it is going, and why it is moving. That is the foundation of the institutional playbook. That is the beginning of professional thinking. And that is what can separate an ordinary investor from the crowd. This was today's analysis on Dalio Marco Mind. If you found this breakdown helpful, write "follow the money" in the comments, because the real secret in the market is exactly that. We do not predict the future, we follow the path of money. And when you learn to see the path of money, the noise of the market becomes lower and the signal becomes much clearer.